Good afternoon, good evening, and good morning as people join from around the world for this amazing event here this afternoon. My name is Robert Towner, and I'm the leader of recruitment, admissions, and business development for online programs at Geese College of Business. In today's webinar, The Economic Impact of COVID-19, Larry DeBrock, Dean Emeritus and Professor of Finance and Professor of Economics, will discuss the impact on micro and macro economies created by the coronavirus. He will provide an overview of current challenges that exist both domestically and abroad, while also providing his insights on opportunities that have been created. Participants will have the opportunity to ask questions. Please place them in the chat or the Q&A feature, and they will be moderated to Professor DeBrock. I would like to introduce today's presenter, Larry DeBrock, Professor of Finance and Dean Emeritus, College of Business, earned his PhD in economics from Cornell in 1980. He served as the 9th Dean of the College of Business from 2009 to 2015. Prior to that, he served as Interim Dean, Acting Associate Dean of Faculty, as well as Associate Dean for Graduate Professional Programs in the College of Business. Professor DeBrock has long been associated with Illinois MBA and has won many awards in teaching, including the Campus Award for Excellence in Graduate and Professional Teaching in 2001, and Campus Award for Distinguished Undergrad Teaching, the Luckman Award, in 1992. His research interests lie in the areas of applied microeconomics with focus on topics in industrial economics, labor economics, and health economics. Over his 40 years at Illinois, DeBrock students have noted his gift for making complex economic concepts both compelling and understandable. With that, I would like to welcome Professor DeBrock.
Greetings. Thanks for joining us today. You should note at the very beginning, what we're going to talk about today, obviously, is the economic effects of due to the coronavirus. But of course, the coronavirus is not the only thing going on right now. So we have a few other conflicting, simultaneous events that we need to take care of. And I need to start by telling you that because here in Illinois and on our campus, we're in what we call shutdown mode. The building, our business school building, is locked, and we are told to stay away from campus. And so I'm coming to you from the living room of my house here in Champaign. We have set up a little temporary studio here. We've got a nice camera. I hope it's working okay. And we have put some soundproofing around in this in the room so that hopefully the sound comes across, and we're making a good example, right? Because we're all supposed to be sheltering in place. So with that, I think I'm going to get started. As I said, and again, there are people who are monitoring questions. Obviously, we have a very large crowd, and so I expect that we'll have many more questions than we can talk about. But hopefully, there might be a set of questions that seem to be consistent, and Amanda, who's going to be helping me out here, will forward those questions to me. But let's go on and talk a bit more about what we're going to do today. We're going to talk about the economics and what's happening to the economy. I have a goal, and that goal is I don't want this is not going to be like a PhD seminar in finance. I'm going to talk to you about what's happening to the economy right now. And it is indeed unprecedented what's happening to the economy right now. And I'm going to talk about different aspects of what's happening. And the goal here is to make you understand, what these events are in a way that you can then be more aware of how to follow these events. No, it's just with everyday newspapers, reliable newspapers like the New York Times or the Wall Street Journal or the Economist out of London, to be able to keep track of these events. And it's also the case that, as you know, probably some of you got this invitation, I don't know, a week, 2 weeks ago, 3 weeks ago, whatever. It's been to an economist who teaches a lot about what's happening in policy circles and what's happening on a day-to-day basis. The pace at which things are changing is staggering. It's just, it's very difficult for us to fully gather in what the effect is on our fellow populations, in the sense of there are lots of people getting sick, and I'll tell you, there's going to be a lot more people get sick before we get through this. But there's also a lot of people who are just suffering mightily in terms of what's happened to their life, their jobs. There's just a large number of people who are in a situation where, without a pay stream, how are they going to do for rent and food? And we're going to talk about these issues, but I want to get it across in a way that I hope you'll understand why this is happening. And I hope you'll be able to understand what happens tomorrow that I don't know about will hopefully become a little bit more understandable to you. Finally, there's one last important thing that I need to talk about. Economists should always talk about this when they start teaching any class. That is, we're going to do this. The focus is going to be on positive economics. There's really two types of economics. There's called positive economics and there's normative economics. And positive economics doesn't mean that it's good or anything. Positive economics just means we're going to talk about what we know from economic theory. Normative economics takes what we know from economic theory and then adds the word ought. So normative economics allows you to have value judgments in play. We ought to have a higher minimum wage. Okay, economists can talk a lot about minimum wage and what the impact of minimum wage is, and there's economists who have different results on this, but that's positive. That's just talking about what we know, positive economics of minimum wage. But also, as a regular citizen, I vote. I have to wear my hat as a citizen, not as a scientist, and I have my own opinions about what ought to be the case in terms of minimum wage. I'm going to try my best to stay away from normative economics here and just try to tell you what we know and what we don't know. Because believe me, there are some conflicting opinions. I know if you're following the paper and understanding, there are people who have different ideas about what the response of policymakers should be to this just unprecedented event. So with that going, let's go forward. I'm going to break in here and start by, I'm going to show some graphs. So the format today is I'm going to talk to you, but then I'm also going to show you some graphs. Not a lot of graphs like we do like you would do in an economics class. I'm going to show you some data, I'm going to show you some stories, and we're going to talk about what this all means. So let me start by sharing my screen. And there it goes. And I have a feeling there are other panelists here who actually have the capability to get in touch with me, would tell me if this isn't working, but I think it's working. So that's the stuff I just talked to you about. And what I want to start about is this first slide is, this first slide is a shot of the 2019 economy using Standard & Poor's 500 index. Now, first of all, this is basically Standard & Poor's 500 index is an index that captures the aggregate change in the prices of equity funds. And we have, sorry about that. We have, these are equity markets, and equity markets are all over the world. And I'm just using the Standard & Poor's 500, which looks at about the stock exchanges and the NASDAQ and the New York Stock Exchange here in the United States. But believe me, all of the stock exchanges, whether it's in Asia, Europe, South America, they're all going through very, very similar events that we're talking about today. So I want to motivate this by making us think, where were we? So I started with the 2019 economy. This screenshot is a screenshot that shows the change in the Standard & Poor's 500 for the entire year. That's 12 months. It started out back here at January 1st of 2019, and it ended, let's see if I could, red pen, way up here. And what I put on the top of the screen is that was a 28.7% growth. That was a great year. That 28.7% was a great year. I don't know about you, but I don't, I may be a practicing professional economist, but my portfolio didn't go up 28.7%. That's a pretty good return, and it epitomizes a really strong 2019 for the economy. But now we move into 2020, And 2000, by the way, this is just a screenshot from Google Finance. I don't know if you could see it, but I captured the URL at the top, but you can just go. Anybody can go. It's free to Yahoo Finance, and you can sort of type in S&P 500. Some of you, most of you probably, when they think about the stock exchange, would use what's commonly reported in the newspapers, which is the Dow Jones Industrial Average. Economists don't really like the Dow because the Dow is just an index of 30 very large companies. The Standard & Poor's 500, as you might expect, is an index of 500 different companies. And those companies are not just large firms in one sector like manufacturing. There are transportation firms, there are manufacturing firms, there are tech firms, there are retail firms. Okay, so they have lots of companies across a very heterogeneous space and industry. So that, to economists, this is a more accurate reflection of what's actually happening on average in the stock market. And as you can see, stock prices, that is equity for owners of companies, grew quite handsomely during that period. And Yahoo always shows either green for the time span you pick, which, as you can see across the top here, you could pick a variety of time spans: 1 month, 3 months, 6 months, 2 years. The time span that you pick, oh, it was green, because now when I go to 2020, this is year to date 2020. It starts in January. It starts from January 1 back here at the beginning of the year. And as you can see, if you were to go for this from this date to 1920, which is right here, to today, this is actually the close last night. This was the close last night because the market's still open today. And last I checked, it was positive. But over that time period, the Standard & Poor's index lost 27.7%. So take a look at that. From the picture before, over the year, we made a whopping 28.7%. That's over the year. Now here in 2020, in the span of just 35 days, we basically lost all of the gains that we put in 365 days in 2019. And so the question is, where's this come from? Where's this come from? And so I'm gonna stop here from this. Sharon, and talk a little bit about more. You may have seen I had three places to talk about, because the economic problems that we're having right now are not caused solely by the coronavirus. There's no question. The impact of the coronavirus has sort of taken what would be a regular recession, which could be caused by these other events I'm going to talk about, and amped it up like on mega steroids. Okay, and that's kind of what the real problem is. But anyway, there's three areas I want you to think about. To an economist, these three areas all could contribute. Now, notice the word I said could. All could contribute to what this event might be called a recession. And we'll talk about that in a minute as we go forward. The first is just general weakness in the economy. So the question is, over that period of 2019, or maybe even in the first month in January of 2020, were there indications that perhaps there may have been some weakness in the economy? Okay, and we'll talk a bit about that. Recessions happen. There are lots of recessions. We call them, economists like to call them business cycles rather than recessions, but there are recessions and then there are boom times, okay? And so these things can come often without any outside structural event happening like this pandemic, okay? They can just happen because the market had got to a point where it needed to do some corrections, okay? The second thing that we're going to talk about is this oil price wars. The oil price wars are another totally spectacular event. And I don't mean spectacular because it's great. To an economist, this is like, wow, is this really happening in the oil market? Are we seeing this type of a change? And that type of a change in the oil market can have relatively important effects on the health of the economy in various countries, not just the United States, but all over the world, because oil is one of the most important inputs. Oil and natural gas are basically energy, are incredibly important inputs to basically every economy. And so we're going to think a bit about that aspect. And then finally, the third thing we're going to talk about is the star of the show today, and that is the coronavirus. These three things all could, and I think probably did contribute to what's happened to us in the past 35 days as we watched the economy around the world sort of melting down. So let's move forward and talk a bit about that first thing I was talking about, which was the general shape of the general weakness of the economy. So on this, I'm going to share the screen again, back to this OneNote. And when I share it back to the OneNote, I had these explanations. And so the first thing I want to talk about is explanation number one, a general weakness in the economy. Could this be what's happening? And so I have this screenshot here from Forbes. And this was a story I cut out of Forbes that pointed out that in January 21st, which was basically 2 months ago, the story was posted in Forbes, and it says this now had become the longest economic expansion in the United States history. Okay, that's the longest time in a row without recessions. It was over 10 years, 126 months, where we had that the economy had been growing. And then I want to say, well, okay, that's good, but was there some indication that maybe it's going to be the time for it happening? I mean, if this is the longest one, then that means definitionally in the past, recessions had come more frequently. In fact, on average, recessions happened about once every 5.1 or 5.2 years, if you just look at the average. So this period of time where we had 10 years without it was pretty impressive. But it also, to an economist, says, well, I think it might be time that this is coming around the corner. And so we'll start by talking about something called the yield curve. The yield curve is a general economic idea that just says that if you take a look at fixed income investments are bonds, bonds of sovereign nations, for example. Fixed income assets, and they're called fixed income because a bond, like say a government treasury bill, if you have a 10-year treasury bond from the United States of America, it's got stamped on the top. Not just the United States, every country has their bonds. It's going to be stamped on the top what the interest is that you're going to get. Okay, that's why it's fixed income. You know it with certainty. There's no risk there. Okay, and typically, if you look at this yield curve, it goes something like this. The yield curve goes up, and the reason is that for low maturity, for bonds that only last 3 months, well, you can go. You'll be happy to only take, for example, 1% interest on that because 3 months is not going to be too bad of a time. What can go wrong in 3 months, you might say? But on the other hand, bonds that there's 10 years, well, investors typically require a higher yield on that. If you're going to tie your money up for 10 years, look, a lot of things can happen in 10 years. If crazy events like 9/11 or hurricanes or tsunamis and all these sorts of things can happen over a 10-year span. So usually investors will demand to get a higher yield out of that. And that's why the yield curve typically goes up. And in fact, it almost always does, except every now and then you get this phenomena where the yield curve actually goes, down, right? Okay, and they call this an inverted yield curve. And in fact, back in August, we had an inverted yield curve. The inverted yield curve showed that this inverted yield curve showed. This is a picture from The Economist, and it was from the August 17th, 2019 Economist, and I got this screen graphic out of it, and you can see that the short maturity 3-month bonds were getting almost 2%, whereas 10-year bonds were getting only 1.6%. Now, how can that happen? Well, usually when that happens, it means that people are very scared. They have a feeling that they want to get their money into something that's got a longer term positive rate because it's the short term is scary to them at this point in time. The short term is commanding the higher rate. The long term is getting a lower rate. And as the Economist article says, and this is from the same story, August 17th of 2019. So remember, this is just back in the fall. At the end of this, they talked about the fact that economists don't like, the economists get worried about about inverted yield curves. And I've highlighted the part. They didn't highlight it, I did. The last 7 recessions in America have been preceded by an inverted yield curve. And so when you see these inverted yield curves, to an economist, that typically says, maybe there is a general weakness in the economy. And in fact, a couple more slides here, and we can talk a bit about this. You know that what happened in September, September of 2018, the Fed finally decided to lower interest rates. Now, why did the Fed lower interest rates? Well, President Trump had been yelling at them to lower the interest rates because he said wanted to lower interest rates to make the economy be stronger. And the Fed had basically not been too interested in doing it for a while, but they finally decided that, you know, this economy might be showing some signs of weakness, like the inverted yield curve. And so the Fed did go about lowering the interest rate by a quarter. Also, here's a story from September of 2019 about the fact that export orders were weakening at the fastest rate in a decade. And again, what I'm just showing you here is a bunch of stories from reputable newspapers like the Wall Street Journal that was showing that there were some pretty obvious signs of weakness in the economy. Okay, it's true. The market was still going up, but there were people saying, you know, this is a bad sign. This is the fastest rate for a drop in a decade. Okay. This was a story from September 5th, Wall Street Journal. Executives' optimism in U.S. economy hits 3-year low. Another not too good sign. Okay. So what I'm saying is that over the course of 2019, while we did have spectacular gains, 28% growth in the equities markets, and sometimes higher in other countries, or lower, but it's basically positive, there were signals that, in fact, this might be ending soon. The second explanation I put up there was this thing called oil price wars. The oil price wars look something like this. Here's the price. I took this picture from a website called Macro Trends, and I got the URL on the top, but you can see this anywhere. Just go out again to Yahoo Finance or a number of places, Bloomberg, all of these places will let you see what's known as the price of WTI. WTI, that's what we call West Texas Intermediate. West Texas Intermediate is the type of oil that is produced in North America. Okay, and it's called West Texas Intermediate because basically that's the first oil fields that we started pulling oil out of in the United States were basically in Texas. At any commercially strong way, there were some. I think the first one was actually in Pennsylvania, but that's the point here. Is this is the price of West Texas Intermediate over, as you can see, from 2016. Let's see if I can get my thing going. Actually, goes back into 2015. And you can see that what happened here is that they've had a relatively strong growth until we got right here, and then there was a drop off, and then again, another relatively strong growth, and then a plunge off the edge here. Where do these things come from? Well, the oil market is a very interesting market in the sense that it's dominated by a group of countries called OPEC, the Organization of Petroleum Exporting Countries, and what we now call OPEC Plus. OPEC Plus is the members of OPEC, plus Russia and a few other countries near to Russia who have all not joined OPEC, but they have basically volunteered to follow OPEC's lead in the sense of restricting their output. You know, enough about demand and supply. We're not going to do any demand and supply curves here. But what happens is that OPEC, by as a group, having disciplined cuts in their production, that is, they're reducing the supply, and that drives up price. And they get successful, and then all of a sudden they have a little lack of discipline. They get successful, and then they have a little lack of discipline. Okay, and so the oil price war here. This is a story from The Economist, March 12th, 2020. So it's 2 weeks ago, and the story is that no one is likely to win the oil price war. Saudi Arabia, Russia, and America will all suffer. And these big three oil companies, this is what's happened over, as you can see, this is the past decade. The United States was not a big player in the production of oil back at the start of this decade. It was basically Russia and the Saudis were the big producers, but with the advent of fracking and shale oil in the United States, the U.S. has had this march where they have basically pushed up to be now the leading producer of oil, producing more oil than any other country. And that's what the start is, a fight for supremacy. But I just want to talk a bit about what this all means. That story from the Wall Street Journal says that this was from a couple days ago, March 20th, and said the U.S. crude posts largest decline in nearly 3 decades. And we can take a look at that decline. You can see what's happened here. Basically, on January 6th, on January 6th, the price of oil was $63 a barrel. That's like right here, January 6th of 2020. And now it's down to, I think, $23 or $24 a barrel. So it's lost $40 a barrel over the period of just a few months. And that's this giant drop. And the question is, you might say, well, look, Larry, maybe that means lower gas prices. It does. You get down the price of oil, price of gasoline is going to go down. And it's true, the consumers will be better off of that. The problem here is that the real question is that I asked this question that says, can low oil prices slow down the U.S. economy? Okay, certainly low oil prices can slow down other economies who basically are reliant on exporting oil. Okay, it might help economies that are completely reliant on importing oil. The U.S. used to be an importer. This story from Bloomberg says it was in November 29th. I'll see if I can highlight this. November 29th, 2019. So this is just, 3.5 months ago. For the first time in 70 years, the U.S. became a net exporter of petroleum. So in the past, when there have been oil price wars where the price of oil has fallen down, that actually was good for the United States economy. It made gasoline cheaper. The consumers like that. Okay, but it also meant that we were not paying out so much money because we were doing a lot of importing in those days. We don't import. We're a net exporter now. And as a net exporter, the drop in that oil price up from 63 to 40 to 23 or 24, there are estimates out there from the financial analysis that this could be about 0.3% reduction in the GDP in the United States. Okay, just in this quarter. Okay, because there are lots of oil firms out there who are exporting, and they're going to get hurt by this. And so, what we're going to do is add that to our list. So let's review where we were. Oh, I'm going to go back and get out of the shared thing so I can talk to the camera. Let's review where we were. We talked about the fact that yes, indeed, we had this big drop in the stock market, reflecting the fact that the economy seems to be in trouble, and the markets reflect that. Because markets equity markets are a reflection of people's expectation about the growth of those firms. There's lots of different stocks you could buy. If you buy stocks, you become an owner, and you're going to buy stocks of firms that you think are going to grow. Well, if on average the stock prices of all these firms on average are going down, it means lots of people think these firms are not going to grow. These firms are going to be in trouble. They're going to get smaller. Okay, and so I don't want to be an owner of that firm anymore. I want to go someplace else. So we had the one aspect of thinking about that market as causing it is just the general weakness in the economy. 10 years without a recession, very unusual. And we had these events like an inverted yield curve. We had these events where firms had posted, had for 3 years in a row, their optimism about what's going on in the economy had dropped. We had these export orders that had dropped the most and fastest in a decade. And lots of other events that we didn't really spend much time talking about. But those are all sort of signals that there was perhaps a general weakness in the economy that was going to make the economy start to turn around. The second thing we talked about was oil. Okay, we just sort of finished that talk. See, for the United States economy, maybe not for other economies, if you're a country that all you do is import your oil because you don't happen to have any oil in your country, which there are lots of countries like that, then a drop of $40 a barrel is going to be a good deal. But in the United States, since they were net exporters, like all exporting countries of oil, that's also going to hurt the economy. And finally, the last thing we have to talk about is this thing called the coronavirus. Okay, we want to talk about the aspect of what is this coronavirus and what's the general impact of this virus on the way we go. Amanda, are we doing okay?
We are doing great, Larry. You have addressed some of the questions that have been posed about oil. We've got some other questions, but I think you're going to dive into some of those areas shortly. And so we'll wait and bring those questions in here in a bit.
Thank you very much. Okay, so let's go back and talk about the coronavirus. So what is the coronavirus? Well, anybody who signed up for this webinar knows what the coronavirus is and the details of it. The first death was announced by the Chinese government in like January 11th. I think it was 10 days later, January 21st, where the first known incident of coronavirus happened in the United States of America. And I think it was March 11th, if I got my dates right, March 11th, when the WHO actually moved it from the status of a problem to what they call a pandemic. Okay, and pandemics are pretty serious things. Okay, and this pandemic seems to be a very serious thing, and we're gonna talk a bit about how we're going to move forward on this. So let me go back to share my screen, and we'll see if this was explanation 3, the coronavirus pandemic. And again, we have this. I was right on those dates, and we look here. This was the numbers this morning of the Wall Street Journal. Remember, this was just essentially less than 2 months ago where this happened, and as of this morning at 6:30 a.m. This was the posting this morning. The Wall Street Journal has a daily briefing on their website and of these data, and as you can see, they got the data from Johns Hopkins. From Johns Hopkins, 6:30 a.m. this morning, and I'm sure these numbers have already changed. But 400, almost 500,000 confirmed cases worldwide, 55,000 in the United States, 802 deaths in the United States, and almost 19,000 people have died globally in a very short span. What we need to do is to think about what's the impact of this, and the reason, the impact. Where does this impact come from? Well, let me first start by talking to you about a recession. And you might ask the question, are we in a recession, ? And the answer is technically no. Okay, that's because to be in a recession, the people who make this decision is something called the NBER. NBER stands for the National Bureau of Economic Research. And the NBER, it's a private nonprofit entity that basically promotes a nonpartisan research on the economy and on policy. Okay, it's a very important group, and it's a group that contains some of the best economists around the world, and they have a group called the Business Cycle Dating Committee. So they actually have a committee that dates when business cycles happen. That is, when are we in a recession? When are we out of the recession? And they have rules, and right now they haven't called this recession. I put down here below that, the government generally uses 2 consecutive down quarters. And in fact, if you read the papers, sometimes they'll say, this isn't a recession yet, because to be a recession, the government there has to be 2 consecutive down quarters. That's not true. I mean, that turns out to be a pretty good, accurate predictor of what the NBER uses. But the NBER committee is not open for you and me to go sit in and watch. It's a committee that talks this over, and they make this decision. But as I said, regardless, the economy here is in trouble. Okay, so whether or not you think we're in a recession or not, the data seems to indicate that we are having our share of problems. I got this picture here. This is from the New York Times, March 19th, which would be about 6 days ago. And it was about the staggering rise in jobless claims this week. And so I call it up in the upper corner NUC, which stands for new unemployment claims. Now this data, I hope that you can see this. On the bottom here, these are the years. So this across the bottom here, we've got 2002, 2004, and it goes all the way out to 2020. And these are new jobless claims. Now, typically when you have a recession, new jobless claims don't happen until after the recession has started has already gotten some legs. Okay, so let's go back to the Great Recession. The Great Recession, which we think of as happening in 2008, that's when most of the damage started happening. And as you can see here, the NBER said that the Great Recession, that the Great Recession actually started in December of 2007. So if you look at December 2007, okay, that's kind of, there's not a lot of unemployment. There wasn't a big growth in unemployment claims. But as you moved farther out into 2008 towards 2009, you can see the economy was beginning to fall apart. And these people hundreds of thousands of new jobless claims as people lost their job and filed for unemployment. And then after that ended, you saw that this kind of went down. But here's the staggering part, or at least to an economist, this is amazing. See what's happened right here at the end of this graph. And I think if I do this correct, I can actually explode this up a little bit. Right here at the end of this graph, which is where we are today, you can see these new jobless claims officially filed last week jumped up to this black dot of 281,000, but filed this week. These data haven't been shown yet, except the states have gathered these data, and these authors were able to get it because, of course, state data is, it's government data, and government will reveal this. Look at this, 630,000 claims filed in just 15 states. 630,000 people lost their jobs in just 15 states out of the 50 states, okay? And if you look at the overall picture, you can see this number, this size is just from a small group of states in 1 week compared to what we saw clear back here when at the depths of the recession, of the Great Recession. And so this type of picture is the sort of thing that causes everyone, I know you and I know me, understand that we are in for a rough ride here, okay? If it's going to have that type of impact in just a small set, less than a third of the states, and I don't know who those were, it could be, they're huge states compared to other small states, but it's still disconcerting. Another story, this was from March 17th, and Mnuchin warns senators that lack of action could result in 20% unemployment rate. Okay, so this is when high level Trump executives, administrators are calling that there's going to be a 20% unemployment rate. That's another signal that, in fact, it looks like people are quite concerned about what's going to happen, what's happening with this economy. And so let's push forward. We say, I think I don't need this. Oh yeah. So what I wanted to do with this slide is that it says 3 possible causes. Now I put causes in quotes because we don't really have a recession yet, but I think we're talking about that seems to be the, but it says there are 3 possible causes. We talked about maybe there's a general weakness in the economy, and that contributed to what this drop off the edge of the cliff. Maybe it also had impact due to the oil price wars, and maybe it had something to do with the coronavirus. Okay, there's one certain effect, and also let's talk about policies. Okay, well, we can have policies to fight recessions, and the 2 policy tools we have is monetary policy and we have fiscal policy. And let's talk about the impact of that. And again, I'm using the United States experience here, but believe me, the European Central Bank, the Bank of China, all of these people are also practicing their own monetary policy, and it's very similar. It's not like anybody has any special tools that other people don't have access to. Okay, and I should go back here for a minute. Monetary policy in the United States, it's run by our central bank, which is called the Federal Reserve. We just call it the Fed. Okay, and the Fed was a very, very significant player in bringing us out of the Great Recession. Okay, and that's because the Fed understood that the Great Recession was essentially caused by a financial market failure. Okay, the failure, the collapse, the bankruptcy of many banks, or near bankruptcy of many banks, and the fact that credit markets froze up and the fact that people were losing their houses because they couldn't get the financing, to pay their mortgage, and all sorts of financial sector issues. And we're not here to talk about that. And you probably, most of you who are here, who did come to this, know a lot about what happened in that department. And the Federal Reserve went in and did something we call quantitative easing, and they bought $4 trillion worth of bonds, U.S. bonds, out of the bank vaults of all the banks in the United States, and they took those bonds out. And in order to do that, they gave the banks cash. But when they pushed all of that cash into all the bank vaults around the country, the bankers just said, "Wait a minute, I just got rid of all those assets that were giving me returns, those fixed income bonds where I was going to get a return when that bond matured, and I got these green sheets of paper that don't give me anything, but they do. I can loan them out." And so what happened is there's a gigantic gush of supply that from all these banks that now had lots of green cash in their vaults, they pushed it out, and that drove the price of money down. The price of money is the interest rate, and as the interest rate went down and down and down, the economy basically was able to get back on its feet. So back to this current case, we talk about monetary policy, and indeed, the Fed has done some strong moves. The Fed this past week, not only they dropped the interest rate even further, the rate drop that they had back in September, dropped it down to 1.25 points. Now it's almost down to 0. Okay, they pushed it down by a very large margin, so the rate is it's still positive, but it's very low. That's good. That's the type of that's the type of monetary policy that should help people be able to get their hands on cash, not just people, but in particular corporations to get their hands on cash. But the Fed also put out a lot of money to help businesses and corporations who find themselves in a credit crunch. Okay, the Fed said, we are ready to loan to you. We are ready to buy your loan. You need a 3-month loan, or you need a 6-month loan right now because you want to keep meeting payroll. You've got no money. You're not selling any cars out on the street, but you still want to keep the people who are working for you, either making the cars or running dealerships. We'll help you with this situation. We'll do these low-cost loans. So the Fed is trying to do that, and it's going to help. There's no question about it. I think every economist would agree that type of activity to help make sure that the financial side doesn't seize up, okay? But on the other hand, the other policy that we talked about is fiscal policy, and fiscal policy is to think about this type of stimulus. The fiscal policy is, what can we do? What can we do to help the economy grow? Okay, and so that type of fiscal policy, think about what we had in the United States back in 2008. We had this TARP program, and the TARP program, this troubled asset program, the government just gave out hundreds of billions of dollars. And essentially what happened is that the federal government pushed the money to the states in the form of block grants. So, for example, the state of Illinois got $50 million. Okay, what can you do with that money? Or 50, what can you do? Can you help build schools? Can you help build bridges? So, what happens here under that type of program is that the government tries to become, and not just helping states do more projects, but maybe they just need to hire people to come in. You think about what happened when we had the Great Depression across the planet back in 1929, the Great Depression, where we did have unemployment rates in the United States of 25%. And the Great Depression lasted an awful long time. In fact, the Great Depression started in 1929, and we really didn't come out of it until 1941. And why did we go out in 1941? Well, there was this little thing called World War II. And in World War II, the United States made a commitment to basically I'll have a picture of it later, but a surprising amount of government money into production. Build planes, build aircraft carriers, make bombs, get meals ready to eat, K-rations for the soldiers, uniforms, rifles, all of these sorts of things. And everybody was working. So the unemployment rate, which had been 25%, went down to below 2% at that time because we basically had all these factories working because the U.S. government was making them work. Okay, that type of fiscal stimulus can have real effects, but you got to be big. Okay, it has to come out big. Now 2 trillion is big. Most economists who had been predicting that this event might happen were thinking it was going to be more in the range of 1 trillion or 1.5 trillion. But it came out that this story was in the paper this morning. They voted it last night, or I think it might have been the early hours of today in the morning. But now there are already economists out there saying this is not enough. They said that you should go big and you should go early, is the saying that people are saying. Go bigger, go early, get that money out there to see what we can do about trying to get this economy to grow. Now, I want to talk to you a bit about one picture. This is a picture from the Atlantic, okay? And I put on up on the top here, this was a story, let's see. Well, I thought I put the date on here, but it's okay. I do have the URL across the top, so you can actually go out there and check the accuracy of it. But this shows the ratio of the United States public debt, that is, how much has the government gone in debt, as a percentage of what's the amount of money that what's the amount of income in the United States? GDP is the amount of income. Somebody gets something for everything we produce, whether it's a car, whether it's my services as a professor. All of these things are producing goods and services, and somebody gets money for it. And this shows that essentially the peaks of this type of stuff is when we are in a war. You can see how here we get this peak for the Civil War. We got this peak for World War I. We got this giant peak for World War II. By the way, this is just another one I want to show you, is that we have this peak for the Great Depression but the Great Depression, we had all these things called WPA programs where the government put people to work to just be, to help clean places or to build houses or do something like that. And that worked, but it worked only to an extent. It took World War II to happen to where we really got out of that depression. And here you see what's happening now is that this table only goes out to 2011. But what I wanted to point out is that during these times of great national problems, you see the government stepping in a big way with spending lots of money. It's not monetary policy. This is actual pure fiscal policy in the sense that the government says, okay, we're going to build a lot of tanks, we're going to build a lot of airplanes, we're going to build a lot of ships, and we're going to build army bases all over so we can train soldiers to get over there and do all these sorts of things. Well, in a way, you should think about this current calamity that we're in as maybe we are in a time of great national emergency, and fiscal policy may need us to be even bigger than, say, 2%. I have a slide here that says this recession is different than the Great Recession. I'll talk to you a bit about that. The Great Recession was basically driven by a financial seize-up. Okay. We had this problem of mispriced derivatives. We had this problem of people who were getting mortgages who probably shouldn't have got mortgages, and the financial market just suddenly collapsed under that problem, and the financial markets seized up. And so the government, as I said earlier, the Federal Reserve stepped in and helped it out. In this case, it's different. Okay, what's happened here with the coronavirus is that essentially we, as a government, are shutting down our own economy. Okay, and again, I'm not trying to say this is wrong. I'm not trying to say this is right. I'm not trying to talk to you about how to think about this issue. But the fact of the matter is, if you look at this, is my speaker working? Amanda, can you hear me?
I can hear you loud and clear, Larry.
Okay, I got a big sign here that says your speaker is not working. So I will ignore that sign and move on. I'm going to share this screen. See, that's what happens when you do these things in somebody's house instead of doing it in a studio. Here's the policies. There's two policy options that people are arguing with right now. And again, I told you at the beginning I want to talk about positive economics. When I want to talk about positive economics, I want you to think about what do we think about this as economists. I'm not a public health expert, okay? But option one is called suppression. And suppression is what we're living in right now in many states in the United States. And that's kind of what happened. That's how the government of China, the government of other countries, governments have done this. You know, they may call them lockdowns. We try to refer to it as shelter in place. All the taverns are closed. All the restaurants are closed. The universities are all closed. The schools are all closed. The idea here is that we want to have a social distancing, okay? And it says the whole idea of this process is we have to somehow beat the virus before we can get out of this recession. If we can't beat this virus, this recession is just going to continue to get worse. Okay, if we can't stop the virus, okay, we're going to get to a situation where, you know, the hospitals are already right now. The stories out of New York are not good. New York is the epicenter in the United States right now, and the medical communities there says that at the growth rate that it's going, it's doubling every 3 days. They will not have enough beds very soon, maybe by the weekend. Okay, and that means so now you have lots of people who can't get in to get health and to try and get healthy. Are those people going to just infect other people, or are they really going to sit in their house and just wait it out, or see if they can successfully wait it out? This problem is one where this idea of suppression says that, you know, it's going to be very painful for many people. I got this line here. It says extremely painful to the millions of people who lost their jobs, to small businesses, restaurants, bars. All of this is very, very bad. But, you know, the stimulus packages are helpful, but government production and infrastructure projects directed at public health and hospital capacity is needed immediately. Look, the idea, the $2 trillion that was agreed upon last night by Congress is a great thing. And I don't think, I'm happy to see people get checks. We gave out checks in 2009 with the Great Recession too. Okay, these are going to be much bigger checks. Okay, and I'm happy to see them give that out. But what really needs to happen is a program similar to what we saw happen when we had, for example, World War II, where the government goes out and says, you know, there are problems here and we need to fix it, and we can help you fix that. And so one of the ways they can help fix that is, for example, devoting some of that money, even more money, to growing hospital capacity, to building respirators, to doing the sorts of things that it's quite apparent that the U.S. Healthcare system is just, you know, it's based on a system that will handle normal life. People get sick all the time. Some people get cancer. Some people have heart issues. Some people just have other things like broken legs. We have a capacity system that handles all of that. But when you have some event like this come out of the blue, where in fact you could end up seeing millions of people contracting this disease, we're just not ready to do this. And so the idea of this suppression is more like, you know, what we do is we need to sort of flatten the curve so there's not that many people who are infected, and see if we can get ahead of the head of this virus. Here's a story, March 22nd, which is 3 days ago. It's in the New York Times by Jim Tankersley, and it says the U.S. shut down its economy. And that's true. Basically, the story says the United States government and all the states, not all the states, but the majority of states who have shut down schools, who have shut down restaurants, who have shut down bars, who have shut down any event of more than 10 people, or more than 6 people, or more than 25 people, depending on which governor you listen to, just can't happen anymore. Those events are in fact what's shutting down the economy. And this is a story that says, this gentleman thinks that's what has to happen, but it definitely shuts down the economy. There's another story here. My battery, my pen, my stylus, which I've never used this long in a row, seems to think that it's about to run out. I will put it on a charger for a minute because I can use my finger.
Larry, a couple questions. Maybe we can pause and take. We're getting close to the end here. Yeah. Some people will have to jump off right at 4. We'll probably go for a couple of minutes.
Give me 30 seconds more.
Go ahead.
30 seconds more. I want to look at the other policy option. The other policy option is what we call mitigation. And that policy option is the option that says that, it's too bad. I presume you guys are also seeing that notice that says that my my stylus is dying.
We are not seeing it, Larry. No worries.
Oh, good. All right, good. Anyway, this policy of mitigation just basically says you should direct your attention at high-risk people over the age of 70, people who have pre-existing health conditions, and other people should go about their business. They should go to work. They should do these sorts of things because the cost to the economy is much too large to suffer with the types of super deep, perhaps depression level. I mean, if Mnuchin is right and we have 20% unemployment, that's basically depression status, okay? And the idea is this going to be too costly to us as a society? Other countries have thought about this. Some countries tried mitigation and switched to suppression. Some countries are still working with mitigation, okay? But this is an open issue. The issues of, these are two different approaches. Economists can tell you what the impacts are going to be on those two. We can't tell you what's right. I don't even think public health people can be for sure of that. But these are issues that we have to deal with. Okay, Amanda, go at it.
Yeah, great. So one of the questions that came in is around the sectors that are being most affected by COVID-19, both positive and negative. Wondered if you had some comments on that.
It's a very bad thing, and I mean, in the sense that a lot of what we consider to be part of the fabric of our life, our restaurants, our bars where we meet after work, and our schools. What is the impact going to be when all of our teachers don't have jobs and our students are all in our house? I'm not talking just, they could be college students, they could be first graders, and there are a lot of sectors that are just getting hit disproportionately. And there are many economists who think that those sectors should be getting more of these free checks in the mail, in the sense that if you're going to hand out cash to Americans, there are certain sectors that are really getting hit hard. Transportation, okay? Taxi drivers, Uber drivers, Lyft drivers, and of course the airlines are all getting hit much harder than other industries. But everybody, there's only a couple of firms, for example, Zoom, people who do, audio visual, sort of distance conference calls like what we're on right now. They haven't been hit nearly as hard because of the fact that they're in greater demand at this point in time. Yeah,
absolutely. Thanks. So a question around the impact on the way we think about things, right? Do you think this pandemic will impact capitalism, or do you think it will encourage a new way of thinking?
I don't think so. I think there's lots of ways that this can go, and I'm not particularly fond of thinking about the really dark ways this can go, but that's a possibility. It really could be a situation where some of the estimates out of Imperial College in the UK about that the deaths could be in the millions, and that's in developed countries like the United States. Some simulations have the deaths as high as 2 million people. Now that's a really dark outcome, and if that happens, it would, I can't imagine how we would get to a point where that happened, in the sense that would our breakdown of social distancing, which I think is kind of, we see across the planet, social distancing actually does seem to cause the daily growth of occurrences is tapering off and sort of flattening the curve. But I don't think it's going to cause us to abandon a market system, which I will call a market system rather than capitalism.
Yeah, thanks, Larry. Question that takes a little bit more positive spin, and this one might be our last, but you've taken a deep look at things that are challenging us, right? Oil prices, COVID-19, the economic impact, kind of where we're at. Any thoughts on what good might come from this?
Well, I don't know if you're going to consider this good or bad. I know some of my colleagues are not particularly fond of delivering online education, but I do believe that many businesses are going to discover that, in fact, the people working online were just as productive as they were when they came to their cubicles. And I think that you might see that there will be not just a small shift, but a relatively significant shift of having people do more telecommuting, so to speak, than coming into office space. It will you can lower your costs. Very expensive real estate in the Midtown Manhattan and in the Loop in Chicago. And to the extent that you can see that all those people who you made stay home in their house in Naperville have actually been just as productive as they were when they were here, you know, that might become a much more significant part of the labor force when we get out of this, and we will get out of this. Okay, yeah, I tend to always be more optimistic on these things than perhaps I should be, but I think we'll get out of it.
Thanks, Larry. Any closing comments from you before we wrap this up?
No, thanks a lot for coming, and I hope that you learned a little bit. And again, I hope that you think about these issues by just looking at, like I said, reputable outlets for your news.
Yeah, thank you, Larry, and thank you all for attending. I really appreciate your time, Professor DeBrock, and thanks for sharing your insights today.
Okay, thanks.